So I got a couple comments here I want to read. And so, yeah, so Jimmy, like I would say like, that's why I created the IUL challenge. Nobody's going to take me up on it that actually can, because they're too scared of what the next conversation would be. I'm aware of that. My point wasn't to avoid spending money on the IUL challenge. My point was to actually create a dialogue around what the heck are IULs and how do they work and what are the expectations and all that stuff. I have both IUL and whole life policy. IUL for almost 3 years, whole life for 6 years. Whole life has far surpassed performance in everything. There you go. From interest and dividends to ease of borrowing just days later. Right, Jaina? That is what I'm talking about. And the reason that that's the case is because you're partnering with the company. If you design the policy properly, there's no surrender charges included. All those are already kind of baked into the policy. So whatever your net cash value is, you have access to a high portion of that, right out of the gate. Thanks for sharing. Okay, somebody said that for Janelle. Boom, boom, boom. I should say that, let's see here. I only sell whole life to people. I actually did the IUL as an experiment, and it's turning out to be exactly what I thought. Yep. So it's funny. Me and my business partners the other day were talking about possibly buying an IUL right now for like $500 a month, just as a like to really maximum fund it, to do a case study on it. I think we're going to do it. That is what it is. And yeah, so Nicole, get a whole life policy. Don't get an IUL if you want to achieve your goals, especially for people that want like to utilize it for real estate investing, for people who do anything of that nature, for business reserves or anything like that. The surrender fees and the surrender schedule inside of IUL is just catastrophic. So here's the deal. What I want to do is, as we look at this, let me just finish this up. In AG 49A, what they did also is they reduced the positive arbitrage illustration expectations to 50 basis points, which is cool. They had to be transparent with their hedging budget, with their supplemental hedging budget. They allow the use of hypothetical benchmarks. This is the downfall of AG 49A. They allowed the use of hypothetical benchmark indexes to set max illustrated rates. What does that mean? This is where the rise of the hypothetical indexes came in, like Nationwide is a great example of this. They have the JP Morgan Mosaic Index, they have the Zebra Edge Index, and all these different things. They're just proprietary indexes that they partnered on to create, to lower their options costs, to do the hypothetical look back period. They basically cherry pick stuff to make it look and illustrate really well. But the bottom line is past performance, i.e. the look back hypothetically. That's not what it actually did. They just get to say there. And there are all these disclaimers in there. And so it's just not going to illustrate the way that it showed. And there's all sorts of additional fees and things that you got to look at with this. Excuse me. And so it's just, to me, when you look at this stuff, it becomes really, really clear that the problem here, in my opinion, I know I like rail on insurance agents. The reason I rail on insurance agents is because they're not digging deeper. The real problem is the insurance companies, that every time a new regulation comes out, the companies just take it and they manipulate it and they take advantage and they try to make the illustrations as sexy as possible, illustrate as high as possible, manipulate people as much as possible. And then they train their agents to do it, and they don't train them on how they actually work. And that's the problem. And that's why I'm so passionate about doing what I do and training agents. So now let's do this really quickly. Let's just go through and talk about how does this work. Like, okay, I've talked a lot about how your policy performance in an IUL is not really directly correlated to the performance of the actual index. Let's say the S&P 500 index, right? So why is that? So let's just say you have a $10,000 premium, okay? So with the premium, you're gonna have money that goes into it. So let's just say out of that, let's say $8,000 goes to the account value, right? And $2,000 goes out to fees, right? So out of the $8,000 account value, right, we're going to have, let's just say you have $1,500 of surrender value, right? So what does this mean? And this is the problem with IUL compared to whole life, is that in whole life insurance, you'd have complete liquidity of this money, because the surrender charges are just taken out, they're baked in. You have liquidity using control of 90% of $8,000 at this point in time. With Index Universal Life, because of the surrender period, they have $1,500 is what you would have access to in this example, right? And this is pretty close to accurate, right? Like as far as all this goes. Hold on one second. Let me see here. What if the IUL has a balance sheet rider and did a max non-MEC for the first few years? Also was illustrated at 5.5%. The access would not be great, would be greater in year one. Yeah, I mean, you could do things so the access can be greater. There are ways, different companies do different things that allow you to put different riders on, to waive surrender charges, to do non-commissionable premium, to allow higher liquidity in year one. But the problem with that is that whacks the commission very, very significantly for the agent. And most agents just don't do it. Once again, even in doing that, you can get a higher percentage of liquidity. You're still dealing, in most cases, you're still dealing with longer surrender periods, and you're dealing with the lack of control, right? The variables that I'm going to get into. So Jason, hold tight, and I'll get there, okay? Buy the S&P and use whole life instead of bonds, 100%. Exactly, that guy, passive dividends and options, smart guy. Buy the S&P. If you want to buy and get in the index, don't do it through a whole life policy. So, okay, I got to say this. I know I get distracted here, but this is what lives are all about. I love doing the comments and engaging with people. So think about it. This is what I always say. Common sense goes a long ways with this, right? So all these IUL illustrations where they're saying you can get, no. They're saying you can get like 6%, right? I can conservatively get you a 6% return inside of an IUL. That's what a lot of agents are saying right now, right? That's I shouldn't say it like that because somebody's going to like clip that out and make it seem like I'm like all about IUL. They're going to just like bastardize my comments. When somebody's saying they can get 6% in an IUL, I want you to use common sense. I want you to say, okay, how are they going to get that for me? Well, I'm going to show you how the money flows through a policy. And so then the next question is like, all right, what is the insurance company getting in their own general fund? They're getting 4.5%. So how do you actually reasonably expect that the insurance company is going to be able to get you 1.5% higher, which is basically a 40% greater return, 40% greater for you than they can get for themselves on a predictable basis? Remember, if you want to get great returns, go work with companies that focus on great returns. Life insurance companies don't get great returns. Life insurance companies only focus on preserving the purchasing power of your capital. That's it, right? And so when you need to understand that, you need to align what the objective and the goal of the asset is to what you're trying to accomplish, right? And so when you look at the company, i.e. insurance companies in the insurance industry, they are not geared to get you good high like returns. They're geared to do what they do, which is preserve the purchasing power, beat inflation long term, like keep your money safe, liquid, accessible, controllable, right? That's what they do. This IUL game is just a failing financial experiment, and I'm telling you, this is going to play out. These are young products, and people say they've been around since '97. I even covered it at the top, but the bottom line is they didn't gain any market share until 2009. Because that's when the story got really good, and that's when they started selling more of them. So we're talking really only about a 13-year window right now that they've sold a ton of them, and it's just been this slow declining hill, and people are just like holding on really tight to this story of a failing product. And I think if you just look at the history speaks for itself. And so let's go to this though, and let's assume they didn't do any of these balance sheet riders or anything of that nature. They just did it standard because it's a standard agent, and this is what 90% of agents do, right? So you got $1,500 in surrender value, but here's the deal: this $8,000 is what they put into the general fund. That's what's working for you, right? So let's just say the hedging budget is created out of this, and that's 4%. So 4% of 8,000 is what? $320, I believe. Yeah, $320. We'll just say it. Hopefully my math is right. So the $8,000 account value creates a hedging budget. So also known as an options budget. Options and hedging is the same thing. Now, I also want to talk about that for a second. If you look at the illustration, they utilize options to buy call options, and that's how they give you the upside potential. And I'm going to show that in a second. But notice that every company uses the word hedging, right? Hedging, not options. A lot of people are selling IULs like, hey, you're participating in this option strategy to give you this upside. A lot of people think of options as being this like super high risk product, the high reward product that can get you these great returns. But no, if you look at the traditional use of how life insurance companies use hedging, which is options, they utilize it to mitigate risk. They utilize it to kind of like flatten out the curve. And so that is what it is.